At 9:31 a.m. in New York, the market suddenly drops. No news breaks, no CEO resigns, no war headline flashes across the screen. Yet billions of dollars vanish in seconds. By the time human traders notice, it's already over. The price moved, orders fired, positions were wiped. And the strange part is this: no one decided to do it. Not consciously, not emotionally, not even strategically. The decision came from machines reacting to other machines. This is the uncomfortable truth markets are starting to face. Artificial intelligence isn't just assisting humans anymore. In some moments, it is the market, and it's beginning to move money faster than humans can even understand why. Pause for a second and think about that. The global financial system, something built on trust, judgment, and human fear, is slowly being nudged by systems that don't feel any of it. And that matters, right now. Because this shift didn't happen all at once. It happened quietly, incrementally, line by line of code. For decades, markets ran on people, traders on floors, phones ringing, gut instincts, shouted orders. Then came electronic trading, then algorithms, then high-frequency trading, and now something different. Systems that don't just follow rules, they learn. At first, AI was harmless. At least that's how it was framed. Models that scanned earnings reports, programs that spotted arbitrage, tools that optimized execution. They didn't decide, they assisted. But markets reward speed, and markets reward accuracy, and machines are very good at both. So firms gave them more control, then more autonomy, then permission to adapt. And somewhere along the way, the line blurred. Today, a large percentage of trades in major markets are initiated, routed, and executed without a human pressing a button. Not because humans are lazy, because they're too slow. When an AI model spots a price imbalance, it doesn't wait, it doesn't ask permission, it doesn't explain itself. It acts, and it acts in microseconds. To understand why this matters, you need to understand something simple. Markets are not rational, they're reactive. Prices don't move because something is true, they move because enough participants believe something is true, or fear that others might believe it first. That feedback loop used to be human. Now, increasingly, it's synthetic. Here's how it works in plain language. An AI model watches thousands of signals at once: prices, volumes, order book depth, news headlines, social media, bond yields, currency moves, sometimes even weather or shipping data. It doesn't understand the world, it understands patterns. When certain patterns cluster together, the model assigns probability. Not certainty, probability. And if that probability crosses a threshold, it trades. Now, multiply that by thousands of funds, each with slightly different models, each reacting to each other's moves. This is where things get strange, because AI doesn't know why the market is moving, it only knows that it is. So when one system sells, another detects momentum, which triggers more selling, which confirms the pattern, which accelerates the move. Humans call this panic. Machines call it validation. And the machine version happens much faster. This is how you get flash crashes, moments where prices collapse and recover in minutes or seconds with no clear narrative. Afterwards, analysts search for explanations, a tweet, a data release, a rumor. But sometimes, the honest answer is uncomfortable. The market moved because machines reacted to each other in a loop humans couldn't interrupt in time. There's a quiet irony here. AI was supposed to make markets more efficient, more stable, less emotional. In some ways, it has. Spreads are tighter, liquidity is deeper, execution is cleaner. But stability isn't just about averages, it's about extremes. And extremes are where feedback loops live. When humans panic, they hesitate, they doubt, they freeze. Machines don't. They double down. And here's the part that rarely gets discussed. Many of these models are black boxes. Even the firms running them can't always explain why a specific decision was made. They can trace inputs, they can review outputs, but the internal logic, the path the model took, is often opaque. So when something breaks, accountability gets blurry. Was it a bug, a bad data set, an emergent behavior no one predicted, or just the system doing exactly what it was trained to do? This is where hype collides with reality. AI isn't evil, it's not plotting, it's not conscious, but it is literal. If you train a system to maximize returns and minimize risk, it will do that. Even if the behavior looks irrational to humans, even if it amplifies instability, even if it pushes markets to places no human would choose deliberately. And the incentives are powerful. If your competitor uses AI and gains a speed advantage, you can't afford not to. If your model hesitates while others act, you lose. So, everyone keeps pushing. Faster data, more autonomy, less friction. The result is a market that feels liquid on the surface, but increasingly brittle underneath. Like ice that looks solid until the moment it cracks. Zoom out further and the implications get bigger. Markets don't exist in isolation. They set prices for pensions, for mortgages, for government debt. If AI-driven volatility increases, the cost of capital changes, risk premiums shift, central banks react. And central banks, ironically, are starting to use AI too, to forecast inflation, to monitor financial stress, to detect instability. So now you have machines watching machines, reacting to machines, influencing humans who then respond politically. It's a closed loop, and no one fully controls it. There's a quiet absurdity in that. We built markets to aggregate human judgment and ended up outsourcing that judgment to systems that don't understand consequences, only correlations. This doesn't mean collapse is inevitable, but it does mean the nature of risk is changing. Not slower, faster. Not obvious, subtle. The next major market event may not start with a headline. It may start with a pattern, a signal, a threshold crossed in silence. And by the time humans ask why, the damage may already be done. So here's the question worth sitting with. If markets are increasingly moved by systems that learn, adapt, and act without human emotion, who is actually in control when something goes wrong? And more importantly, who notices first? The humans watching the screens, or the machines watching each other? That answer may define the future of finance.